Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news. That can be a little bit confusing, misleading, and take you off course. And I hope to make it actionable, understandable, and clear. What a lovely week of weather here in Dallas, Texas. For my listeners in other locales, I hope you're enjoying the same. We've got a great week for you. We are going to look back at some fascinating data on what percent of money managers have actually stuck with Amazon.com. See what we can learn from it. There was also a fascinating gentleman who passed away, Mr. Daniel Kahneman. He was a Nobel-winning pioneer of behavioral economics. We're going to look at some of his insights and realize we certainly are standing on the shoulders of giants. And in closing, what you all, I'm sure, were begging to hear, there's a new stock on town. Donald Trump's DJT stock. So it recently went public. We're going to talk about the phenomenon that is the size of company and what we can learn about efficient market theory along the way. And if we have time, I don't know if we will, I'm just going to remind you of how difficult it is to anticipate market booms, which, whether you believe it or not, it feels like we're in. At the top, this was via X or Twitter, a gentleman named Mark Andreessen, who is a venture capitalist and named partner on the firm Andreessen Horowitz. He got to be the first name. Andreessen Horowitz, Mr. Mark Andreessen. He also invented Netscape, the browser, for some of my older millennials who in computer lab were learning how to use the internet. You probably used Netscape. He put out a chart. Headline, Maximum Amazon Intra-Year Drawdown, meaning how far down did his Amazon go? And then further clarification was given by another one of his followers with this question. I want you to think about it. And on Andreessen's chart, it showed 2008, it was down like 80%. And then 50% drawdown here, 30% drawdown here, 40%. I mean, the drawdowns were huge for Amazon all across the way. Andreessen says nobody can take the pain. But check out this quote. At a meeting with the U.S. growth manager, this growth manager mentioned that they bought Amazon in 2006. They ran a search on a Bloomberg terminal. That's one of these terminals that has access to great financial data to see how many institutional managers had held on to their position in Amazon since 2006. You remember the adage I'm always preaching. Keep the costs low, investing simple, and time horizon long. So the question is, who kept their time horizon long? So what do you think, class? By the way, in this time period, Amazon is up 100x, 100 times since 2006. Do you know what percentage of these institutional managers have actually held on to their positions? Think about it. 0.2%. I'll say that again. Of all the institutional managers that held Amazon stock in 2006, 0.2% have held on today. And yes, I'll say it again, it's up 100 times since that. Now, the data is interesting. Why? The real application, why is it? Well, Andreessen, as I mentioned before, showed all these big drawdowns. So, big drawdowns, people begin to think, maybe this isn't for me. Maybe Amazon's not what I thought it was. Maybe this book thing online may not last, etc., etc. And before we shake our fist at these institutional managers, what we should realize is, I don't know that you or I could have done any better. It is so difficult. And you don't just sell because things are bad. Sometimes you sell because things are good. Amazon's up. Oh, it's up too much. I'm out. I'll take my profits and leave. One of the great, and of course it would have been lovely to buy Amazon and hold on, but hindsight's 2020. If we were to read the headlines and read the news, there would have been reports of Amazon's demise all across this time period from 2006 to present. Which one of us would have had the fortitude and foresight to actually stick with his position and oh, by the way, the numbers would get bigger, right? So if you invested, whatever, $10,000 in 06, all along the way, as your position grows, you will feel more and more pressure to sell. Now, the index fund solves this. Of course, if I could go back and pick the exact stocks which would go up 100, I wouldn't need the index fund at all. But the great gift of the index fund is it forces you and it forces me to hold on to positions. Just hold on. So let us keep it simple, and then let us remember, whenever someone acts like they are a hotshot investor, remember that Bloomberg terminal data. Where were all the hotshots holding on to Amazon? What was going on there? And then an article on behavioral economics. This was interesting to me. I oftentimes wonder, well, where did we get the ideas we have? Oftentimes Morgan Housel is someone I see as my North Star when I think of behavioral economics. He wrote a book called The Psychology of Money. He's got a great blog. He's kind of this modern day psychologist with money, helping us think about it. This is Daniel Kahneman, who died at 90. He was a Nobel winning pioneer of behavioral economics. He was the Princeton University psychology professor, the article explains, in Wall Street Journal by Justin Lahart, whose work laid the foundations for the field of behavioral economics. I didn't know all this. So Kahneman and his friend Amos Tversky, who died in 96, they upended traditional economic assumptions that people consistently act rationally and with their self-interest at heart. Instead, experiments conducted by the two Israeli-born psychologists showed that when presented with complex situations, people often rely on rules of thumb that can lead them to behave irrationally. Oh. Now this reminds me of something, listener. Does this remind you of something? This is what Peter Thiel taught us, the author of 0 to 1, the venture capital founders fund. He said this about investing. He could have been standing on these men's shoulders. He said when the consumer is unsure of how to operate in a particular marketplace, they just gravitate towards brands. And he said that in the response to a question saying, hey, why is it when people buy financial products, they don't go with what's in their best interest? They buy very high-priced and complex and underperforming products. And Peter Thiel said, well, look, like when you are faced with choices you don't understand in a marketplace you don't understand, you'll just go to a brand. And we do people do that with cars, people do that with phones. There are a whole host of various people who do that. And oftentimes the results aren't that bad. You buy a Toyota, that's pretty good. You buy an iPhone, not so bad. You gravitate towards a high-priced mutual fund, not so good. And you don't gravitate, typically you're sold it. These two found that people derive patterns and probabilities based on small sets of data. Yep. Not understanding the role of randomness. The article says this, for instance, ascribing skill to a fund manager who beat the stock market a couple of years in a row and not recognizing the role of luck. They also found that people tend to feel losses much more keenly than gains. Now, this might just be, oh, ho-hum, who cared? But these guys figured this stuff out when it wasn't ho-hum. And so we have benefited tremendously from their work. And I will say the statistics is, I can't emphasize enough how important it is to have a base level understanding of statistics. There's a small little red book I have that is a funny title. It says How to Lie with Statistics. Boy, howdy. When I see financial products sold or deals pitched, I see all sorts of ways that you can white lie with statistics. You can white lie. You often don't know you're being misled because there are so many different ways to show data. For you and I, what we can do is, yes, be grateful for these men, but also realize, I need to equip myself with some of the lessons they've given us. And of course, the application here in the article is you're ascribing skill to a fund manager who beat the stock market a couple years in a row. Now, I'll add my own commentary, not realizing what a histogram represents. You might have seen a histogram. It's a distribution of results. It looks like a wave, and those tails. And what you realize is, by definition, there will be folks that end up in the top 10% in any given sample. I don't anticipate you absorbing this via audio as you gather the children around the speakers this evening or this morning or this afternoon. However, let this be a recommendation to you. Don't let statistics fool you. Don't let folks armed with statistics fool you. Stick with the tried and true. And then, this is just, who knew? I did not realize this was happening. This is Mr. James McIntosh, senior markets columnist for the Wall Street Journal. He says this. He says, why it's so hard to know what Donald Trump's DJT stock is worth. And what does he say? He's trying to figure out what is the size of this company. He says, forget financial analysis. Even finding out how many shares there are is a challenge. And usually reliable data for the closing market capitalization, that, as you'll recall, is the total value, all the shares multiplied by the stock price equals this total market capitalization, on Wednesday ranged from 2.46 to 13.55 billion. Ooh. And he then goes on to list all these different information providers and who says the company's worth this. We have some that say it's worth 2.46 billion. Google Finance says it's worth 9.44 billion. Yahoo Finance says it's worth 7.51 billion. The correct figure, apparently, according to Wall Street Journal, the market value is 8.97 billion. But he's not sure. And I'm not either. I haven't done the research. I'm just reading the article. Nor do I care to do the research. My conclusion will be the same. No surprise. But when I look at a story like this, I then go, what's happening here? Get this. This company that today, I suspect this issue will trade wildly, but it's looking at $8.97 billion. Maybe this is yesterday. So that's about a $9 billion company. That's huge. That is absolutely huge. Did you know that this company, the first 9 months of last year, had sales of only 3.3 million? Sales. That's 3.3 million. So it's at times like these where I must explain myself. Because, and oftentimes I'm challenged on this, and rightfully so. People will tell me, you see, Robert, you're an efficient market theorist. Well, now don't you see? Can't you understand? There's nothing efficient. This is the DJT stock. It appears as though it has nowhere close to the value of $9 billion, and it's being pumped up for political reasons, perhaps by supporters of President Trump. I don't know that. This is just me speculating. I can't put my mind around anyone purchasing this for economic reasons, although they may be there. Maybe the speculators are out and they're trying to make a quick buck. And this same dynamic, you could go back and say, remember GameStop, and remember there are various other moments where you would look and say, all right, efficient market theorist, what are you doing? A couple points here. The first is this. The market can remain irrational longer than you can remain solvent. Old phrase. What does it mean? There's no rule that says foolishness can't prevail for a very long time in the investing world. Throughout history, from tulip mania to the late 90s tech boom to the late 1920s in America, there have been various periods where in hindsight you look back and say, this is no good. So how do I, an investor, reconcile the craziness that's occurring in these individual issues with my own commitment to market cap indexing? Well, a couple things. One, these, I'll call them crazy meme stock issues, typically don't find their ways into indices. Indices have some safeguards in them that in order to get into a particular index, I'll say the S&P 500, but even the U.S. Total stock market, they have a couple hurdles you have to get through. So it's a big deal to get in the index, and it's not as easy as, oh, great, I've got a big old market cap I'm in. So that's a protection for you. But two, as much as I'm an efficient market theorist, I'm more of a cost matters theorist. So the great secret sauce of indexing is not necessarily that the market's perfectly efficient, although I believe it is very efficient. It's that it is effectively free. So when you compare that to the alternative, which is paying someone to pick stocks they think are fantastic and not buy the ones they think are foolish, it's tough to beat free over a decade. It's almost impossible over 2 decades. And you've heard me spout the SPIVA report data. 5% of these active managers over a 15-year period will beat their respective indices. So even when a crazy meme stock like this pops under your purview, just remember, these things are like shooting stars typically. In the short run, the stock market is a voting machine. In the long run, it's a weighing machine. It's a scale. So at any given time, there could be something like this, like a DJT stock that is going up a lot. And there may be temptations to buy at X, sell at 2X. Buy at X, sell at 2.5X. Just in and out. Speculation is what that is, guys. And as we'll recall, wealth gained hastily will dwindle, but he who gathers little by little will prosper. So when anyone tells me they want to make wealth quickly, I think of that verse and I think, I'm not sure you do. Generally, it will not work out well for you. Generally. What will work out well for you? I never thought you'd ask. Let's keep those costs low, that investing simple, and that time horizon long, because that's what's going to give you the best shot on your investing journey. Happy Easter, family.